this relationship between sales and the cost of goods sold even has its own name. It's called gross profit. And financial statements are designed to actually show you gross profit. And they were asking me, like, well, why is cost of goods sold its own expense category? Why doesn't it fall into the financials the way that it normally does? Why does it have its own metric? And I was explaining to them about how, whether you're selling a product or a service, the principle holds the same. If you're not even making a profit at that gross profit level, let me throw out some numbers. I think it makes it easier to follow. Let's say that I have a blanket and I bought that blanket for $100 and I'm now going to sell that blanket for $80. Obviously, if I'm going to take a $20 loss every time I sell that blanket, it does not matter how many of those blankets I sell or how much I have in sales volume. In fact, driving up my sales will only put me out of business faster, because it is absolutely impossible to come back in any way, shape, or form from a negative gross profit margin. If you're not even selling your product or service at a profit, no matter what happens, you will not be sustainable as a business. I might have small margins, like if I sold the blanket for $110, then in theory I could say, if I was to sell millions of these, even though my margins are small, the margins would add up and it would cover my overhead and I would be profitable. But I flip it the other direction and I sell it for a $10 loss. Driving up sales will only put me out of business faster.